Welcome to Ultimate Learning Hub, the hub that was started to transform our online learning experience. In our today's session, we are going to focus on conceptual framework. We are going to look at conceptual framework. Now, what is a conceptual framework? A conceptual framework is basically it's a framework for the preparation and presentation of financial statements. It's a framework, or its main purpose. It sets out the concepts that underline the financial statements preparation for external users. When we talk of the conceptual framework, basically, it's a statement of generally accepted theoretical principles which form the frame of reference for financial reporting. It also helps to provide the basis for development and evaluation of financial reporting standards and the assessment of practice of accounting. Basically, it's a document that was set or that was developed by IASB, that is International Accounting Standards Board, to help or to guide accountants in the preparation and presentation of financial statements. So it's basically a document that will be handy in preparation and presentation, will come in handy in the preparation and presentation of financial statements. Now, why do we need the conceptual framework? What is the purpose of conceptual framework? As stated, that the conceptual framework was developed by International Accounting Standards Board, which is abbreviated as IASB. So the purposes of conceptual framework revolve around the IASB. There are 5 main purposes or reasons for having the conceptual framework. Number 1, to assist IASB in the development of new standards and reviewing the existing standards. So to help IASB, which is the International Accounting Standards Board, to develop new accounting standards and also to review the existing accounting standards. The second purpose of the conceptual framework is to help IASB in harmonization of accounting standards and procedures, to ensure that all accounting standards are harmonized or are synchronized so that they don't contradict, they work together, and also all the procedures are set in place that help in application of the accounting standards. The third purpose is to assist the national standard setting bodies in development of national accounting standards. Every country normally has got the national accounting standards body, the regulator of accounting profession in every given country. So IASB, through the conceptual framework document, assists or supports the national standard setting bodies in development of national accounting standards. It also helps or assists preparers of financial statements in applying standards to deal with topics which aren't discussed in the standards framework. So it's the duty of accountants to prepare financial statements. So they'll be guided by this document, which is called the conceptual framework, to apply standards to deal with topics which are not very clear or are not clearly discussed in the standards framework. And finally, to assist auditors to give an opinion on whether the financial statements conform with the international accounting standards or the international financial reporting standards. In brief, it assists auditors to give an opinion on the financial statements. So the purpose of the conceptual framework, this working document, are 5. Now, what do we cover in the conceptual framework? What does the conceptual framework include, or what does it entail? Conceptual framework, basically, it's divided into 4 major areas. So when we look at the scope of the conceptual framework, number 1, it covers the objectives of financial statements. Number 2, it covers the qualitative characteristics of financial statements. Number 3, it looks at elements of financial statements by defining them, seeing how to recognize the elements, and also how to measure the elements. So number 3, it focuses on elements of financial statements. How do we define them? How do we recognize them? And how do we measure these elements of financial statements? And number 4, is on what we call concept of capital and capital maintenance. So when we talk of conceptual framework, that is a summary of what conceptual framework entails. So we'll start looking at these scope items one by one. So the first item or the first scope was the objectives of financial statements. So what are the objectives of financial statements? There are four major financial statements. That's the income statement, balance sheet or statement of financial position, statement of cash flow, and also there is the statement of changes in equity. So when we talk of objectives, objectives revolve around those four financial statements. So the objectives are to provide information on the financial position of the business through the balance sheet, financial performance of the business through the income statement, changes in financial position through what we call statement of changes in equity, and the cash position of the business through the statement of cash flows to a wide range of users of financial statements to enable them make informed decisions. So when you have been asked, what are the objectives of financial statements? There are four objectives of preparation of financial statements. Number one, to show financial performance of the business. Number two, to show financial position of the business. Number three, to show changes in financial position of the business. And number four, to show the cash position of the business. So that's the objective of financial statements. Now, still related to the conceptual framework, there is what we call assumptions of financial statements. In other words, when you are preparing financial statements or when you are running your businesses, there are some two major assumptions that you must take into consideration for you to operate and run the business effectively. Now, these two assumptions, number one is what we call accruals basis assumption. Accruals basis assumption states that for income, we should recognize income when it is earned, but not when cash is received. While for expenses, we should recognize them when they have been incurred, but not when cash is paid. That is the first assumption. The second assumption is what we call going concern. Going concern assumption is the assumption that the business will be in operation in the foreseeable future. In other words, the business will be in operation tomorrow and the day after tomorrow. So, which means the business does not have the intention to stop its operation in the foreseeable future. Accruals basis assumption, as stated earlier, cannot work without the going concern assumption. Now, the second scope item in the conceptual framework, number one was objectives of financial statements. Now, number two, the scope item number two is qualitative characteristics of financial statements. Now, qualitative characteristics are the qualities, the features that financial statements must possess, must have, so that we can conclude that these financial statements are good or they have been prepared in order. Now, these qualitative characteristics of financial statements are divided into two groups. Number one, there is what we call fundamental qualitative characteristics. And number two, there is what we call enhancing qualitative characteristics. So when we talk of qualitative characteristics of financial statements, they can be divided into two major groups. Fundamental qualitative characteristics. Fundamental are the primary qualitative characteristics, and enhancing qualitative characteristics. Enhancing are the qualities that improve on the primary, improve on the fundamental. In other words, enhancing are the secondary qualitative characteristics. So when we start with the fundamental qualitative characteristics are two. Number one, relevance, and number two, faithful representation. We normally say that information is relevant if it can influence economic decisions of the users. Information is relevant if it can influence economic decisions of the users. Information is relevant if it is material. Information is relevant if it is significant. Information is relevant if it is important. Now, what is the definition of materiality? We normally say information is material if its omission or misstatement can influence economic decisions of the users. Information is material if its omission or misstatement can influence economic decisions of the users. The second fundamental qualitative characteristic is faithful representation. Now, financial information must faithfully represent the phenomena it purports to represent in both description, and when I talk of description, I'm referring to words, and also in numerical depiction or in numbers. Information has faithful representation if it is complete, it is neutral, and free from biasness and errors. So when we talk of information that is faithfully representative, there must be completeness in that information. There must be what we call neutrality, and it must be free from biasness and errors. In that case, we can conclude that information is faithfully representative. Now, on the other hand, we have what we call enhancing qualitative characteristics of financial statements. Enhancing qualitative characteristics. So when we talk of enhancing qualitative characteristics, we have four major qualities. Number one, verifiability. Number two, timeliness. Number three, understandability. And number four, comparability. So when we talk of enhancing, the qualities that improve on the primary qualitative characteristics are enhancing, are secondary. Number one, verifiability. Now, accounting information should be, as far as possible, capable of verification by knowledgeable and independent observers who must be in a position to reach a consensus. So we are saying that information is verifiable if it is possible to be verified by knowledgeable and independent observers. In other words, we can have independent people who can review the information prepared, and they conclude that the information prepared is as it is. In that case, if they can be reviewed by some people who are objective, who are not biased, if they review, in that case, we say we have met the qualitative characteristic of verifiability. Secondly, however good information is, it must be presented before decisions are made. In other words, the quality is timeliness. Timeliness means financial information should be reported to decision makers reasonably soon to be capable of influencing their economic decision. So you must, as an accountant, you must present the information to the users before they make a decision with it. The third qualitative characteristic which is enhancing is understandability. Now, when we talk of understandability, there is a need to classify, characterize, and present information clearly and concisely so as to make it understandable. So the preparers of information must present the information in a way that it is very clear that the users can easily understand what is presented to them. And finally, comparability. When we talk of comparability in this case, an economic decision such as maybe buying of shares of a company involves a choice amongst alternative investment. The essence of an economic decision is a choice among maybe possible causes of action. So when presenting information in comparability, you must ensure that the information you present we can be in a position to compare one year to the other. In other words, we must be consistent in the way we present the information to enable us be in a position to compare one period to the other or one business entity to the other. So the key point there, we must be consistent in application of accounting policies. The third scope item after the qualitative characteristics is definition, recognition, and measurement of elements of financial statements. What are the elements of financial statements that we need to define, to recognize, and to measure? There are 5 elements of financial statements, which are assets, liabilities, capital or equity, income, and expenses. So let's start by defining these elements. What is an asset? An asset is a resource controlled by the business entity as a result of a past event. A resource controlled by the business entity as a result of a past event from which future economic benefits are expected to flow to the business entity. So assets are what the business owns, the resources owned by the business. So assets are resources controlled by the business entity as a result of a past event. And these resources will generate economic benefits in the future. Now, remember, the key word there is controlled by the business entity. So what is control? Control is the ability to generate economic benefits from, of course, use of the assets, and also to restrict others from using the assets. So that's asset. Now, assets can be divided into 2 groups, non-current assets and current assets. Under non-current assets, they can also be tangible and intangible. The second element of financial statements, when we are defining them, are liabilities. What are liabilities? Liability is what the business owes others. In short, a liability is a present obligation as a result of a past event, the settlement of which will result into an outflow from the business of resources having economic benefits. So a liability is an obligation that is present. It's a current obligation. And that obligation is as a result of a past event. And when you settle that obligation, it will result into resources flowing out of the business. The third element of financial statement is what we call capital. Now, capital is owner's contribution to the business. Capital is the amount invested in the business by the owner. What the owner invests comes into the business. Still related to that, there is equity. On the other hand, equity is the residual interest from the assets of the business after deducting all liabilities. In other words, equity is what we remain with from the assets of the business after removing liabilities. So note that capital is the amount invested, but equity is wider. So capital is part of equity. So equity combines capital plus other reserves. And the reserves can be share premium, retained earnings, revaluation reserves, capital redemption reserve, general reserves, etc. So when we take the share capital and we combine it with the reserves, that is what gives you equity. So capital is owner's contribution to the business, while equity is what we remain with from the assets of the business after deducting all liabilities. The fourth element of financial statement is what we call income. Income is the increase in economic benefits in a given period, and this increase in economic benefits is in the form of inflows, what comes in, enhancement of assets, in other words, increase in assets, or reduction in liabilities. And this increase in economic benefits must result into increase in equity. We have already defined equity. And this increases in equity is not contribution of members, because if there is an increase in equity as a result of contribution of members, that is capital. So what is income? Income is increase in economic benefits in the form of inflows, increase in assets, or decrease in liabilities, resulting to increase in equity apart from contribution of members or contribution of owners. There are two types of income. The first type of income is known as revenue, and the second type of income is known as a gain. Now, when we talk of revenue, revenue is increase in economic benefits from the ordinary activities of the business. The income we get from what the business exists to do. So if it's a business that sells chairs, the income you generate from sale of chairs, in other words, sale of goods, sale of inventory, that is revenue. If your business is to sell services, to offer services rather, the income you generate from offering the service, that is revenue. On the other hand, gain are the other incomes that is generated from non-ordinary activities. For example, if the business disposes non-current assets, that is income, but it is not revenue, it is a gain, because our business is not to dispose non-current assets. So income from disposal of non-current assets is a gain, while income from sale in the ordinary course of the business is what we call revenue. From sale of goods is called revenue. Finally, there is what we call the last element, which is the fifth element, is known as expenses. Expenses are the opposite of income. So expenses are decrease in economic benefits in the form of outflows, decrease in assets, or increase in liabilities, and they result to decrease in equity apart from distribution to owners. So expenses must result into decrease in economic benefits. And what causes this decrease? Outflows, decrease in assets, or increase in liabilities, resulting to decrease in equity apart from distribution to owners. When we distribute to owners, maybe that is dividends. That's not distribution to owners. Maybe we are repurchasing shares or dividends. Now, after you have defined the elements of the financial statements, the second step is to recognize the elements. To recognize means to include the elements to the financial statements. In other words, if it's furniture, to put it in the balance sheet as an non-current asset. We talk of you are recognizing the furniture in the financial statements. So recognition means including the elements to the financial statements. Now, these elements are normally recognized to the financial statements if they meet certain conditions or if they meet certain criteria. There are two criteria, conditions that must be made for the elements to be recognized to the financial statement. The first criteria or condition is it must be probable that future economic benefits will come to the business. So if it's probable that future economic benefits will flow to the business entity or out of the business, in that case, you have met the first condition. Probable that future economic benefits will flow to or from the business entity. And the second condition is the costs can be measured reliably. In other words, we must give a value to the element. So you can only give a value if you are in a position to measure it reliably. Now, you have already defined the elements, you have already recognized the elements, but now we ask ourselves, what value will we place to the financial statements? In other words, measurement of elements of financial statements. There are four bases that can be used to measure the elements of financial statements. The first one is you can use what we call historical costs. So historical cost is the original value of an economic item. For example, when we talk of furniture, maybe this furniture was bought 5 years ago. The amount you paid 5 years ago to purchase the non-current asset furniture is what we call the historical cost. So the historical cost is the original monetary value of an economic item. The second costing measure that can be used is current cost. So current cost is today's market value of a new asset. For example, if you go to the market today to buy new chairs or new furniture, what you pay for the new chair is what we call current costs. Number 3, we have realizable costs. Realizable cost is the disposal value. In other words, when you are disposing the old asset, when you are doing away with the old asset, how much do you spend? That is called realizable cost. And finally, the 4th measure that is used to cost is what we call present cost. Present cost is the discounted cost. In other words, discounted value of the assets and liabilities. Remember, there is what we call time value of money. Time value of money concept tells us that with time, money loses its value. So the value of an asset today is not the same as the value tomorrow. So when we convert the future value to the current, or what we call present value, that is what is known as present costs. Finally, in the conceptual framework, there is what we call concept of capital and capital maintenance. What is capital and capital maintenance? When we start with capital, we have said capital is owner's contribution to the business. On the other hand, capital maintenance is the process of trying to balance the accounting equation. And the accounting equation is normally assets is equals to capital. Now, when we look at capital maintenance, there are 2 forms or dimensions of capital maintenance. The 2 forms or dimensions of capital maintenance are, number 1, financial capital maintenance, and number 2, physical capital maintenance. Now, financial capital maintenance is looking at the value of the elements in terms of their value. In other words, we are looking at what is the value of non-current assets. The value of the firm is seen in monetary terms. For example, if I have chairs in my business, what is the worth of the chairs? I can say that my chairs are worth $1 million. In other words, that is financial capital maintenance. On the other hand, when we look at physical capital maintenance, we are looking at these elements in terms of their numbers. In other words, how many chairs do you have? Remember, in financial, what is the value of chairs? When we talk of physical capital maintenance, we are looking at how many chairs do we have? We can say that we have 10,000 chairs. In that case, it is physical capital maintenance. In conclusion, under conceptual framework, what are we looking at? Remember, a conceptual framework, we have said it's a document that guides in the preparation and presentation of financial statements. We have also said this conceptual framework is developed by IASB. We have looked at 5 purposes of having the conceptual framework. And then we have looked at scope of the conceptual framework, which includes number 1, objectives of financial statements. Number 2, qualitative characteristics of financial statements. Number 3, definition, recognition, and measurement of elements of financial statements. And finally, number 4, what we call concept of capital and capital maintenance. That brings us to the end of conceptual framework. In the next session, we'll be looking at what is known as regulatory framework. So ensure you join the next session, which will be looking at regulatory framework. Thanks for joining the Ultimate Learning Hub. And remember, we have said, what is our objective in Ultimate Learning Hub? Our purpose is to ensure that we transform your learning experience. We transform your online learning experience. Thank you. And let's meet in session 3.